Hello everyone, how's it going? Welcome to my channel where we talk about the most interesting stocks every day. In the world of investment, people are often asking themselves where is the next thing going to be and how to accurately seize the opportunity before things take off and how to profit from safe and predictable income streams. It is precisely to answer the last question that the title SCHD has been created. It is an exchange-traded fund (ETF) correlating with some of the world's most famous and successful companies, distributing dividends from the stocks incorporated within. To a large extent, the Schwab US Dividend Equity ETF chooses the safest and the most stable industries in our economy to invest for the long term. Perhaps another reason why SCHD has attracted so many people's attention from the market participants is its price action since the inception, as well as the dividend track record. Over the past 5 years, despite strong economic headwind, the Schwab ETF managed to increase its share price by almost 50%, which is very impressive and has beaten many of the more riskier counterparties. If we go back as far as 2011 when it first began trading, SCHD increased by more than 183% since the beginnings, which really shows how far the stock has risen. So, before the rest of the video continues, if you would like to see more stock analysis videos like this one, please remember to like, comment, and to subscribe to my channel. SCHD has been hanging around the $76.41 recently. That's a 4.3% jump from just over a month ago, around 6% climb over the past 6 months. And this is pretty impressive, all things considered. It even bounced back by almost 13% from its low on October 27th, sticking to around 67 level. Now, let's zoom out a bit and look at a big picture. Over the whole year that just finished, SCHD has been cruising sideways, ending just 0.5% higher than where it was when 2023 just began. And guess what? 2024 seems to be following on the same path. Not much has changed over there. But we have to be cautiously optimistic in this regard, especially with the stock market feeling a bit shaky lately. Here's the cool part. SCHD doesn't cost you much to hang on to. With an expense ratio of around 0.06%, it's like having a wallet-friendly ticket to over 100 US stocks. Big names like AbbVie, Texas Instruments, and Broadcom are in the mix, so you're basically investing in the American economy without the headache of managing individual stocks. But what about dividends? SCHD's got you covered there as well. In a world where inflation is doing its thing, SCHD is holding strong, offering around 4% yield, which is pretty solid. And get this, they've been increasing those dividends over time at a pretty steady rate. It's like the gift that keeps on giving. Now, why is everyone buzzing about SCHD? It's because it's a favorite amongst big shot investors and regular people like you and I. Plus, with the expectation of the interest rate doing their own dance, SCHD might be gearing up for a nice ride. So, keep your eyes peeled as SCHD still navigates through these markets' volatilities, probably with more success than the otherwise. With that being said, here are the technicals. The trading volume of Schwab is currently around 5.8 million shares, compared to the average volume of 4.1 million shares. Over the previous 52 weeks period, its price fluctuated between $66.67 and $78.23. The volume of shares traded tells us how many shares have been bought and sold at any given point in time, if there's enough liquidity to support any trading strategy in particular. If the float is too thin, it could be easy to push the stock price around, sure, but the low liquidity could also mean that the demand is limited as well. Like, when we compare the current volume against the average volume, there might be the possibility for trend reversal or breakthrough if the difference is too large. The stock were to break through when current volume would be significantly higher than the average volume, and vice versa for reversals. The assets under management of Schwab US dividend equity is around $52 billion. As we compare the current price to the historical price fluctuations, the stock is 5% higher than the 1 month low, 15% higher than the 3 month low, and 15% higher than the 52 weeks low. On the options market, where we often see a hint on the market sentiment about where the stock price is probably going to go next, the implied volatility is 10% compared to a historical volatility of 11%. The put-call volume ratio is currently at around 31%. It's normal for many stocks to have a higher put option volume than what they deserve because many institutional people hedge their long positions with put options. Most recent volume of options is around 1,000 contracts a day versus the 30-day average of 1.9 thousands. Regarding open interest, the most recent volume of open interest is around 62,000 contracts versus the 30-day average of 60,000 contracts. Now, regarding the shareholder structure, institutional shareholders hold about 40% of the outstanding shares. The biggest shareholders include Charles Schwab, the Bank of America, and Morgan Stanley. Usually, it's always good to see some institutional participation when holding a stock long term because they may offer a layer of stability and reliability. In the medium to long term, it means that people are generally confident that this particular company can deliver value in the long term, which is an important factor to consider for investors. I personally consider the minimum threshold to be around 25 to 30% of institutional ownership. There are many exceptions to that rule, as there always will be great companies mostly owned by retail traders. The current short interest is 874,000 contracts of the total float, and 40% of those transactions come from the dark pools. Typically, if the short interest is above 15% of the total volume and a significant portion of the short volume comes from the dark pools, there may be like an argument that says there is a short attack going on with short squeezes in the horizon. It's not the case with Schd Etf. Of course, analyzing securities from a fundamental perspective is always helpful, but it should be complemented with extra external forces at play. Investing in the stock market can sometimes feel like riding a roller coaster with its many ups and downs. This roller coaster may seem arbitrary if we compare the company's operational reports and its share price action. It is profoundly influenced by real-world uncertainties, central bank decisions, and many other intricacies between the real economy and the stock market. Even if the end result may differ from their participants, the stock market is deeply intertwined with the pulse of the world, and real-world uncertainties can significantly alter and affect its delicate balance. Events like elections and geopolitical tensions can often trigger fluctuations, leaving investors and citizens around the world alike on the edge of their seats. The mere speculation of a change in political leadership or a brewing conflict can cause stocks to sway, let alone when those speculations turn into the grim, dark reality. If the recent events have shown us anything from an economic perspective, it's quite obvious that the market participants will show less reassurance in the state of the local economy and the stability of our societies. Additionally, we must face the fact that the looming risks of a recession may cast a shadow on the market. When economic indicators hint at a potential downturn, investors may become jittery, leading to heightened volatility. It is crucial to understand that the stock market isn't solely driven by the cold, hard numbers, but also human emotions and perceptions that play a significant role in shaping the market dynamics. We can actually argue that our collective and subjective perception of the future is more important than the objective facts, and that our personal impression from the immediate surrounding can affect our perception of events that happen very far away. And within these immediate surroundings is the central bank, a key player in the financial orchestra. The interest rates set by the central banks have a profound impact on the stock market's rhythm, especially for exchanges like Nasdaq, where the tech companies often dance to a different tone. When the interest rates rise, the borrowing becomes more expensive, affecting the profitability of those companies. For the more speculative tech companies that often operate on the thinner profit margins, or in fact, negative profit margins, higher interest rates can be particularly challenging. Investors may reevaluate the risk associated with those companies, leading to sell-offs and increased market volatility. Conversely, the lower interest rates can create an environment conducive to borrowing and investing, potentially boosting the stock prices. One perplexing aspect of the stock market is its ability to march to its own beat, seemingly detached from the real economy. While the economic indicators may point to a struggling or booming economy, the stock market may tell a very different story. This divergence becomes particularly apparent during periods when the real economy is faltering, yet the stock prices continue to rise. This phenomenon can be attributed to a variety of factors. Central banks' interventions, government stimulus packages, and investors' expectations can all contribute to this disconnection. It's essential for investors to recognize the fact that the stock market is not a perfect reflection of the real economy. It is rather a complex system influenced by a multitude of variables. When managing all these complexities, investors are wise to exercise vigilance and to broaden their perspective. Looking beyond the fundamentals of individual stocks, it becomes crucial to consider the macroeconomic and monetary landscape. Understanding how global events, central bank policies, and economic indicators interact can provide a more comprehensive view of the investment landscape. Macroeconomic factors like the inflation rates, the employment numbers, and trade balances should be on the investor's radar as well. Likewise, when keeping an eye on the central bank communications and policy decisions, they can offer insights into the direction of the interest rates and the overall market sentiment. Above these elements, that are all individually important to consider, there is also another one, the idea or the concept of cyclic movement. It is one thing to assume that things will always come and go, the good like the bad, but it's quite another to assume that the next cycle will look exactly like this one. The current market may be towards the end of a super cycle that began with the collapse of the 2008 real estate market and the quantitative easing that followed. A massive amount of capital has been injected in the market for more than a decade, and this has played a significant part in the recovery and later the takeoff of the asset prices. These policies may not come back, and there may not be the same kind of recovery that we have enjoyed after the last market collapse. The past doesn't guarantee the future, and it is no different this time. So really, the stock market is a dynamic and intricate ecosystem influenced by an array of factors. Real-world uncertainties, central bank decisions, often arcane relationships between the market and the real economy all make up to what we see on the stock market. In this ever-changing landscape, investors should be well served by adopting a holistic approach that considers both fundamental analysis and macroeconomic perspectives. By staying vigilant and embracing a multifaceted view, investors can navigate the stock market with a far better understanding of the forces at play. Now, in general, I suggest slowly establishing a position over an extended period of time frame, The possible reduction in the interest rate might boost a fresh wave of confidence in a positive market direction, drawing in additional funds towards stocks and ETFs for potential returns. Yet, it's crucial to remain cautious considering the presently high historical market price of a CHD. Despite the chance of ups and downs, SCHD could serve as a reliable stabilizing factor in a portfolio geared for the long run. I would recommend to commit between 10 to 15% of a portfolio in SCHD and to split the allocation in batches of 20% at a time over the next 3 to 6 months to benefit from further retracements if there's any.